From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, it's Valentine's Day, and love is a roller coaster. No one knows that better than the bond market. With yields whipsawed by U.S. data, with retail sales driving yields lower, leaving traders to gauge the Fed's will they, won't they path on rate cuts. But we begin with the big issue. The data paints a murky picture.
Right now, I would describe the data as somewhat concerning.
The prospect for further rate cuts has diminished considerably.
We've got sticky inflation, and if we've got sticky inflation, the Fed is probably going to be done cutting rates.
If we slow further from here, that could start to add to the momentum of a stagflation storyline.
What does the Fed do historically when the data is volatile? They pause.
So I wouldn't take January as your starting point of a new trend. I think the market understands that.
The market is going to move to the expectation that we're not going to get a cut for quite a while.
You could be pushing the 10-year yield above 5% sometime later this year.
It's very possible that we see a 5% 10-year note this year, and I'd even go so far as to say in the 5 to 5.25% range.
Will they or won't they? We're looking at the bond market volatility that we saw just in the 10-year yield alone this week. You might remember Wednesday when the inflation data, the CPI, came in hot, and you saw yields surge to a peak on the 10-year of above 4.65%. You fast forward just a couple of days here, and you're looking at a move of 20 basis points lower. Just an incredible set of circumstances here, and a lot more economic data, frankly, ahead. Let's flip up the board here and think through what this could mean, because with the divergence of views here on just where that 10-year goes, there is one thing underpinning these concerns. Look at how this chart so closely tracks what we have seen over in the 70s. This potential reacceleration of inflation is what investors are most concerned about. Everyone over the last several months, you've seen from Stan Druckenmiller to Apollo's Torsten Slok, which shared this chart just this week alone, is watching whether this is the trend we meet again, particularly when there's so much uncertainty around how the Trump administration handles their tariff strategy and whether that would cause more inflation indeed ahead for the U.S. economy. And speaking of inflation, Fed Chair Jay Powell testified before the House right after Wednesday's CPI print.
We're close but not there on inflation. And you did see today's inflation print, which says the same thing. I mean, we've made great progress toward 2%. Last year, inflation was 2.6%. So great progress, but we're not quite there yet. So we want to keep policy restrictive for now.
And joining us now, Vishy Tirupattur, Chief Fixed Income Strategist and Director of Quantitative Research at Morgan Stanley, and Pramila Agrawal, Head of the Custom Income Strategies and Portfolio Manager at Loomis, Sayles. Vishy, when you looked at the CPI data, the subsequent PPI data, there's a lot of hope that PCE, the Fed's preferred gauge of inflation, will actually show to be quite promising. Do you think that there could be risks to that kind of thinking?
Well, I agree with that expectation. If you take the CPI data, which was clearly hot, but there were a lot of one-off items, but the PPI data was certainly much more helpful. And you look at the PCE, which is the indicator that the Fed focuses on, Fed's favorite measure of inflation. We are expecting that the core PCE would, when we get the core PCE data in a week or so, we expect the number to be like a 0.29% month over month. So that just basically means that on a 3-month annualized basis, inflation would be CPE inflation would be at 2.29% on a year-over-year rate at 2.59%. And just to put that into perspective, the year-over-year number in December was 2.81%. So, look, not ignoring the fact that there are elements of CPI data that were really hot, much hotter than expected. But the point is, convert that into PCE measure. We think actually maybe some of the angst that we are going to see accelerating inflation might be a bit misplaced.
How do you feel about this, Pramila? Do you think that the inflation story will ease enough to finally allow for a rate cut if it's warranted this year?
Sonali, we think that we are probably not going to see, multiple rate cuts this year. There is that last mile problem that we have been talking about for a while. We have seen CPI go down from 9 to 10% in June of 2022 when it was at its peak. And it's really in that, 2.5–3% range. It's ebbing and flowing. There is still a very strong labor market, which is causing the wage inflation to remain high. We really need to see that come down to like 4% or so to start seeing a services disinflation, which we are not really seeing to the extent we want to. The other place is shelter, and that has captivated a lot of headline news. And there we are seeing that shelter, again, inflation has come down significantly, but stays in that range, which we are still not comfortable with. And lastly, goods inflation. We have seen a really nice disinflation since the peak of COVID, and that has stalled a little bit. Now, is it going back in the inflationary regime? I think it's a little early to tell right now. And the tariffs, their impact is not yet fully baked in, but we will probably see those numbers pop up more in Feb and March number. So for Fed, there is really no hurry, and that's what Powell said in his testimonial. And he calls the Fed policy less restrictive. And note the language less restrictive, because it is definitely still in somewhat restrictive mode. We have had 100 basis points of easing, but should they be in a hurry to cut rates? We don't think so.
Vishy, how do you think about not just the short end, but also the long end of the curve here? Another thing that did come up in Chair Powell's testimonies is that lack of control that the Fed really has over the long end. At the same time, we spoke to the National Economic Council's Kevin Hassett earlier this week, where there was a pitch here that fiscal prudence would really help lower the long end of the curve. At the same time, House Republicans, their opening offer really for increasing the debt limit is greater than the GDP of France. It's more than $4 trillion of an increase that they're asking for. Do you believe that there can be a clamp down on where the upper bound is on the 10-year with what we're seeing in the market right now?
I think so. But I think that we will come to that point in a different angle than what you just portrayed, Sonali. I think and I just heard Pramila speak, and I don't think we are that different in our expectation. Our expectation that our economists think there will be one rate cut, not multiple rate cuts in this year. We expect that rate cut to be in June, and there is clearly uncertainty associated with it. But much of the discussion that we've been having with respect to tariffs has focused on inflation, which we think will be a one-time pickup in inflation. But I think less of the discussion on the markets are focused on what tariffs would mean for growth. So we think that tariffs would have a somewhat lagged but meaningful impact on growth, depending on how wide and extensive and severe the tariffs are going to be. So we think that will actually weigh on this. So, one thing I would recall is that in 2018, the Fed conducted 2 simulation exercises in September of 2018. And the point of that exercise was to see how the central bank policy should react to in the context of tariff-induced inflation. And basically, the simulation results were that a central bank that responds to tariff-induced inflation by keeping policy tight generates much worse economic outcomes in terms of employment and inflation than a central bank that looks through the tariff-induced bump in prices. What we want to say is that the optimal monetary policy that is more likely to look through short-term raise in a pickup in goods inflation and maybe focus more on a policy necessary to support the economy, given the impact of all the tariffs on growth.
We are out of time. Our big thanks to Vishy Tirupattur of Morgan Stanley and Pramila Agrawal of Loomis, Sayles & Company. Looking forward to having you both back soon. Of course, it's another big end to a massive week in the bond market. Now, coming up next, the auction block. Issuance action on both sides of the Atlantic, with reverse Yankee deals becoming more prominent. Euro-denominated bonds issued by U.S. companies at the highest level to start a year since 2007. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where U.S. high-grade sales have slowed, but there was plenty of action elsewhere. Big sovereign deals from U.K. and France adding to new debt sales in Europe's primary market this week, bringing the total to more than 83 billion euro. The U.K. sold a record amount of 10-year bonds after attracting the highest ever demand, while France sold 30-year bonds with more than 115 billion euro worth of orders. And here in the U.S., we had Treasury auctions for the 3, 10, and 30-year, with both the 10 and the 30-year sales tailing. A new issue coupon rate for the 10-year was the highest since 2007. And to a story we're watching closely here at Bloomberg News, this week Morgan Stanley and 6 other banks sold $4.74 billion of X Holdings debt, allowing the lenders to finally rid themselves of the bulk of their exposure to the financing that they had arranged for Elon Musk's purchase of the company formerly known as Twitter. Demand was so strong that the buyers paid face value for the debt due in 2029. And speaking of credit, iCapital's Anastasia Amoroso spoke earlier this week about her preferred area of the bond market.
I'm not entirely positive on the bond complex because I think yields are probably range bound and spreads are tight. Spreads are tight in high yield. They're tight in leverage loans and investment grade corporates. So if there was one place that I would look to within fixed income, would actually be the private credit side.
Joining us now, Christina Minnis, Global Head of Credit and Asset Finance and Head of Global Acquisition Finance within the Capital Solutions Group at Goldman Sachs, a newly formed group where you have private credit, you have leverage loan markets that have been going wild, frankly, for the past 2 months. I want to get your perspective here on that kind of leverage finance versus private credit equation. How are you thinking about it from where you sit?
Great. Well, thrilled to be here. Happy Valentine's Day. We think the convergence of private credit and the public markets are going to continue. And there's tremendous opportunity with the growth in private credit, both equity and debt, as well as the need for capital. And so if you think about how much money needs to be raised across a certain number of verticals, whether it's energy, infrastructure, power and utilities, digital, it's trillions of dollars. And so the private credit markets and their growth and robustness combined with the public markets really presents a really attractive investing opportunity for our investing clients. And for our issuing clients, the private credit market continues to be a really important market. So both markets are growing, they're robust, and they're strong.
So let's talk about leverage finance for a moment here, because December was very strong. January was also very strong. What are you seeing in the pipeline that would suggest that strength would continue?
Couple data points. We had the largest inflow into loans in January, which says a lot about that asset class. We've had 5 LBOs print in the month of January at SOFR plus 300 or better. One came at 250 over. And if you look back over a decade, only 13 LBOs have ever hit that spread. So that tells you there's a very good tone in the market to finance sponsors. In addition, I think the market has absorbed the reality of rates are probably going to be here at this level for longer. And again, you and I have talked about this in the past. A 4.5% Treasury is a cost of capital that over 20 years is quite acceptable. So we're quite bullish on not only the liquidity in the markets, both across leverage finance, IG, private credit, real estate, but also we believe the M&A market's going to pick up.
Well, what's incredible to me is not only do you see that data that you had shown, but also all this dry powder that's still on the sidelines. You have some of the best levels of deal making from the big private equity firms in years. And you saw it out of, for example, Blackstone's report, the money they're willing to put to work. Is this in some ways a historic time in the leverage finance markets, given the potential opportunity that could exist and the flows that you're seeing?
I I think it's historic in the perspective of when you look back over time, the size of the funds that have been raised are enormous. We also now have the private credit market. People comment on 1.6 trillion. That's another way to finance these transactions in a very productive way, right? And so it is historic in the sense that the U.S. capital markets have innovated and provided this form of capital, and we haven't even talked about structured credit, collateralized lending, and what's going on in that market. So from a deal perspective, the equity funds are larger, the capital markets are robust, so that bodes very, very well for a very strong 25-26.
Another interesting dynamic is something you mentioned just a little earlier, that you're seeing all these areas in which private credit in particular could enter into.
Yes.
That's typically outside the scope of that $1.6 trillion that we always talk about when you talk about private credit. That's often direct lending.
Right.
To the extent you see private credit move away from bread and butter direct lending towards deals, where's the biggest opportunity here? Where's it all going?
So I think it's probably in the investment grade space, in the structured product space. And you've heard some of our competitors talk about that, and we completely agree with it. I think one of the largest opportunity sets for our investors and our issuing clients is in what we call private investment grade. And we've started to see that in transactions to fund some of these large capital needs that our corporate clients need to fund over the next decade. And that's coming in the form of private investment grade credit or structured product. And we couldn't be more optimistic about the growth of that market.
There's such a huge debate among these private credit firms around how liquid this market is and whether it's looking more and more like a public market. Mm-hmm. Where do you stand in that debate?
So a few of the players, largest players, are really working on turning it into more of a liquid market with a trading dynamic. I think the first player in that market is focused on their own private credit product to trade those products. Will it become more liquid over time? You would think it would. Is that good for investors? Generally speaking, liquidity it enables people to manage risk. But I think the debate is out on how quickly that will happen. But again, there's a lot of discussions in the market right now amongst a couple of players, again, focused on their own portfolios versus creating a broader liquid market.
Now, another question is about risks, because this has been a fairly exuberant market once again, particularly when it comes
golden age
of private credit, and you can even say a golden age of leveraged loans once again. So what stops the party if there's anything that were to?
Yeah, we were talking about this morning with the rest of your reporters. I think a surprise view on rates, if we get a read in February that the inflation isn't where Fed wants to see it, I think a tightening cycle would be pretty challenging for folks to absorb. I would say geopolitical. We've seen some serious geopolitical activity last summer that would create a lot of volatility, so that makes us nervous. And anything that would affect CEO confidence or investor confidence. And of course, we're all watching Washington very carefully in terms of some of the legislative commentary around tariffs. But I'd probably focus on rates and also geopolitical.
Yeah, so much of what's happening in Washington is impacting the 10-year in particular. And it's interesting, we have seen just this week the 10-year rise well above 4.5%. Yep. We're ending the week below that level once again. A little earlier this week, we were talking to Jim Caron over at Morgan Stanley, put the upper bound at 5 to 5.25 on the 10-year. What if we got there? What would that mean in terms of ripple effects for the markets that you operate in most?
Look, I think one of the challenges in the M&A market recently, both in standard LBO across all industries as well as the real estate market, has been rates. And so if we felt rates were going to be above 5% for longer, that has a direct correlation on valuation, right? And so I think that would be one element that would be challenging, because I think sellers have been really hoping for relief on rates to help drive their expectations on their sell side flow. So that would be one impact. And I think, corporate earnings, right? I mean, that would have an impact on corporate earnings, which, flows through to the equity markets and the IPO market.
You know, one place that we've talked about before being very sensitive to this higher for longer rate environment was real estate.
Yep.
But I think back to a conversation we had with John Gray about a month ago now, a couple of weeks ago, about how not only has the industry potentially bottomed here, he believes it has bottomed, he also says office is bottoming. How interested are your clients in getting into harder hit areas of the real estate market right now?
So it's a really good question. We're pretty excited about the increased liquidity in the CRE market. In particular, we've seen interest now in Class A office space and retail, which is something we hadn't seen for a long time. And there's a lot of liquidity there. We have spreads at all-time tights. And again, I think the challenge is valuation. So the capital markets are there. And the question is, will our buyers and sellers come to agreement on value? But through my lens, which is a credit lens, and the businesses I run, I'm very excited to know that we've got liquidity there, very deep liquidity for the first time.
If you had to zero in on one area of your market that you're most excited about for over the next several months, what would it be?
It's probably private investment grade, the growth there. I've always, obviously loved leverage finance. Through our asset and wealth management brethren, we have a top 3 asset manager. We've been very dominant in private credit for many years. But this move into private investment grade, I think, is really a game changer for our clients and also for our formation of our new group, Capital Solutions Group, which we're very excited about.
Christina, it's great to have you with us here early in the year. Of course, seems like a bit of a sea change underneath the market right now. Good to have you. That is Christina Minnis of the Capital Solutions Group at Goldman Sachs. And still ahead, the final spread a week ahead. The holiday shortened week with the Federal Reserve minutes, of course. A lot of people will be looking closely at the debate underneath the hood there, and plenty of earnings. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. It's a shortened week, but coming up, we have U.S. markets closed with the President's Day holiday, but then we resume on Tuesday. Fed speak from Mary Daly and earnings from Baidu and Toll Brothers. Wednesday, minutes from the FOMC's January meeting. CPAC gets underway, and we get earnings from Philips and Rio Tinto. Thursday, Walmart earnings and the G20 summit in South Africa, and more earnings from Mercedes, Airbus, and Rivian. Friday, global PMIs, U.S. home sales, and we look ahead to Warren Buffett's letter to shareholders on Saturday. Let's see how much value is still alive and well in this market. From New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.